Nothing has as much power over your financial future as your credit score. If you can wrap your head around 5 factors of a credit score, then you're well on your way to improving your financial outlook. If you are new to credit scores or want to refresh your knowledge, you have come to the right spot. In this video, I will talk about credit scores and what defines a good or a bad score. And at the end, I will share with you 5 factors that affect your credit score. Imagine this. Your good friend since high school calls and asks to borrow $500 for house repairs. He promises to pay you back with interest. Then, later that day, while in line at the grocery store, the person in front of you, a stranger, asks you to lend him money and promises to pay you with interest. Which of them are you going to lend your money to? Your friend, right? You know him better than the stranger at the store. A long time ago, before credit scores existed and dinosaurs roamed the earth, borrowing money was super difficult. Some loan officers would base their approval on whether or not they already knew you. Others based it on your reputation in the community. And don't even get me started on non-related factors, like your upbringing, nationality, gender, or the color of your skin. It was dark times. And not only that, it was exhausting. Getting a loan would take forever. So, a new system was created to know if you are credible or not. Credit scores. A credit score is a number given to you based on your credit history over the previous 5 to 7 years. These days, 3 separate credit bureaus, Equifax, TransUnion, and Experian, keep track of this data. If your record is excellent, you will have a good credit score, and obtaining a loan will be easy with favorable terms. But it will be difficult for you to get a loan if your credit history is inconsistent. It means you have a poor credit score. A low credit score really sucks, but it isn't the end of the world either. I'm Kim, by the way, and recently I've been doing a deep dive on credit scores and wanted to share a few of the key fundamentals with you. Hopefully, it will help you stop falling victim to this powerful and rather annoying number. The best known variety of credit scores are FICO and Vantage scores. Vantage score places emphasis on total credit utilization and balances, while FICO focuses on payment history. These form the basis for your credit report, but results vary depending on how they evaluate your data and how much importance they give certain elements. A credit score can range from 300 to 850. Anything over 650 means a good performance. A 750 credit score indicates an excellent rating. But if you are below 650, start thinking of more ways to go up the ladder. Amazingly, contrary to what you might think, a 0 credit score does not mean you are a bad borrower. It only tells the lender that you have never carried any debt. For some people, not taking on debt is a good thing. But if you want to maintain a healthy credit score, you should have at least 1 active account. Keep a few credit card accounts active and pay them in full every week. It will help you maintain a positive rating in your credit report and boost your credit score. Your credit score is based on 5 factors: credit mix, new credit, length of history, payment history, and credit utilization. Let us look at each one and see how big of an impact they have. The first and the most important factor to consider is your payment history. Payment history accounts for around 35% of your overall score. This makes sense, since a good payment history allows creditors to trust you with their money in the future. On-time payments make your payment history flawless, but if you pay late, your credit score suffers. Late payments can stay on your credit report for up to 7 years. The second factor is credit utilization. This accounts for about 30% of your score. Credit utilization tracks the ratio of how much you owe to your total available credit. For example, if you have a $10,000 credit card limit and you owe $1,000 on it, that is a 10% credit utilization. Contrary to popular myth, good credit rating does not come from never using credit. In fact, not using your credit at all is worse than using it responsibly. You want to present to creditors that you can manage a reasonable amount of debt. It demonstrates your dependability as a borrower. Factor number 3 is your credit history. One of the more visible criteria is the length of your credit history, which accounts for 15% of your credit score. This relates to the average age of all your open accounts. So, if you opened a credit card account 6 years ago and have kept it active, Your credit history is 6 years. Once a loan is paid off or you close a credit account, it is no longer included in the calculation. This can actually lower your credit score. Remember, this is the average length of time. So if you have a 2-year-old account and a 6-year-old account, your credit history comes out to 4 years. This is why, if you pay off an old account, it can actually lower your credit score. The longer you have been borrowing, the better for your credit. The fourth factor is your credit mix. This one accounts for around 10% of your credit score. Lenders appreciate it when they see that you have a range of active accounts. It is better to have a car loan, student loan, mortgage, and a few credit cards than to have all your money tied up in just one of them. It demonstrates your responsibility and ability to manage many forms of debt. The more diversified your credit, the better. The last factor is new credit. This accounts for 10% of your credit score. New credit considers how frequently you take out credit or apply for loans. Some creditors request a copy of your credit report when you apply, and if it is a hard inquiry, it will show up on your credit report. This can negatively impact your credit score. Try to limit these to 1 a year on average. Any more than that, and banks will start to worry that you are overextending yourself. Of course, knowing your score is just the first step. What can you do to improve your credit rating? If you'd like me to share some tips on that, just leave a comment below. There is no denying that credit scores are important, but even more important is knowing the best way to use your money when you receive your paycheck. So, click this video where I share exactly what you should do the moment you get paid. See you there!